how did I come across this whole idea? Well, I had a huge need, and we're going back 20 years when I really embarked on being a serial entrepreneur instead of an investment banker, and just realized how hard it was to find and to keep really great employees. And so the design of the solution really had to be one that would align the best interests with the owners, be really flexible, be easy to administer, that somehow would be scalable across multiple states as we grow, that would really reward people, incentivize them, and link some restrictive covenants. And I call it fiduciary duty. We're all working for this entity, and a lot of people don't think about it as this living, breathing person when it really is in the eyes of the law. That's why we form LLCs or corporations, is they could be sued and it would protect us as founders or owners. So when we get right to this nut of the exercises, you form or own a company. That company is this entity, and we owe a fiduciary duty to it. What does that mean? It means we have to really look after its best interests, sometimes over our own, even as owners. We have to care about that, all the stakeholders that are involved in that, the suppliers, the employees, the investors, particularly if you've used any other than your own money. So what you want with your top employees is for them to also take on a fiduciary duty to care more about the enterprise and its well-being, because it's the one that's paying them. So that's where their job comes from, and their pay. You want them to think about it, which would include not harming it. And so in not harming it, some of those things would be restrictive covenants. Those would be non-solicitation and sometimes non-competition agreements. So it's don't take my customers, don't take my suppliers, don't take my other employees for some period of time. And I think that's completely fair. Unfortunately, there's certain states that don't agree with business owners on these topics and make that really prohibitively difficult. In fact, I had a situation where I owned a business, and unfortunately, one of the top people worked for me in California and was going to steal the business, and could have. They left none of the non-compete, non-solicit anything, and I'd given them some equity in the business. They could have just stolen everything and not paid a dime. And lucky, I found some good lawyers and figured out how to deal with it, but nobody would like to deal with that. And it was really possible, if they had done certain things a different way, they could have taken the entire business for nothing. They could have taken my other employees, all the customers, suppliers, investors. It was just this crazy situation. So being able to put in place restrictive covenants in the deal is about alignment and loyalty. And then, of course, you want it to be defensible if somebody challenges it. So going back to the origins of it, I started in the own operating company where I was working and my employees were employees of it. And inside of that, I put the form of a profits or a capital interest. Now, there's a lot of different ways of doing these. I structured mine where they were an out of the money capital interest. And the whole idea was that it was like, I called it an Enterprise Valuation Alignment. So I wanted people to think about the long term, and if we were to sell the business at some point, that they would participate in it. So it's like a stock option, but in a way a little bit more powerful. So I started with this inside of the company. Now, certain problems exist inside of there. I did successfully use it across 5 of my own companies. I actually sold one of the businesses I was part owner of into a really sophisticated private equity-backed company. They use a form of this that is extraordinary, and it's been one of the keys to their success in driving from 100 million in revenues when I met them to 5 billion today. They are an amazing company. I took what I was doing, I modified it by what I learned from them, but then I've taken it to a whole new level. The whole concept is you design it so there's no upfront taxation to the employee and no cost to them, so it's an award, just sort of like a stock option. And it works where you think about, you say today's valuation, it's at the manager or owner's discretion. So you say, for an example, you say, our business today is worth $15 million. So I'm going to issue an EVA unit that's a percentage of anything that's in excess of $15 million, so that they don't have to pay any tax on it because it hasn't happened yet, and then they can participate. And say 3 years later, you look at it and you say, I want to issue some more to some new employees or some additional employees or the same employees. And let's say the fair market value at that point is 26 million. So you would issue a new class or a new EVA with a deemed unit price. That's a really technical term, but we use deemed unit price for the second slot, saying, hey, anything in excess of 26 million, we'll share a percentage of that. And then let's say we sell the business in year 5 at the end of it, and we sell it for 56 million. We're going to, whatever percentage, the first people will get between 15 million and the 56 million. And the second EVA units that were issued had a baseline of, say, 26 million. So they get the 30 million, which is the difference between the 56 million and 26. Not all of it, they get a percentage of it. So this is how EVA units work. So they're capital interest. Really, quite simplistically, if you take apart, you start off with what's the owner's or the founder's baseline value, take the EBITDA, earnings before interest, tax, depreciation, amortization, put it by a multiple, you get a value. And then you could say, I expect that to increase by some percentage every year, so it'll just go up. Step 2, when explaining it, you say, hey, as the company grows its EBITDA, we would expect the multiple to increase. Why? Because we know that bigger companies are slightly less risky in the eyes of the buyer. So multiples tend to go bigger for bigger companies. As you grow, you would expect that to increase. Show the value, less the founder's baseline. Now you're going to share some percentage of it. Let's just say it's 25%. So the third part of it is you look, we've authorized 1 million EVA units, and from the get-go, there's no value to them because the baseline is the current value. So current value minus baseline is 0. If you go out to year 5, let's just say there was 8.5 million of excess over founders when they sell. Those million authorized units would have a deemed unit price of $8.49. Okay, kind of cool. Now, this is an example. Didn't come from anything, but you take that deemed unit price, you start issuing it to your key contributors or key employees. You issue some in the year 1, year 2, year 3. They look at what's going on in terms of how many values units they have, the hypothetical value until there's an exit. There's no thing. And then you've got the deemed unit price. So when they were issued, the end price, say $8.49, would be, you would subtract $2.11 from somebody that got it in year 2, 90 cents from somebody that got it in year 1, and 0 from somebody that got it from the get-go, right when the program was formed. So you can create a lot of value, and it's in excess of what the founders would have had. So basically, the founders are keeping a lot of these EVA units, and they're simply rewarding people for something in excess of their own expectations. So that's a way of aligning. I used this really successfully. Then I ran across a customer, a client of mine, who said, I'm not sure I'm ever going to sell, but I want to share excess profits or something where when we beat target, I want to share some of that. So I was like, well, hey, that's a really good idea. So we learned some lessons too. We realized it's better to take it out of the whole operating company and put it in a holding company, because let's say you're an LLC in your operating company, and that's where you issued the units. Technically, by IRS regs and other things, you'd have to start giving a K1, and you'd give a K1 anyway to these EVA unit holders, your key employees, but then they couldn't be W-2 employees. So it created this all other problems with benefits and salary. And so moving their ownership unit into the holding company, now that started solving some problems and it went a lot further. So we used some other structural things that made it a little simpler, lots of other little bells and whistles to it. Now, said, how do you solve the problem for annual profits? Well, we created a new LLC structure where its sole purpose as an entity is to let your key employees or key contributors, because you could have independent contractors in there or anybody else as well. You simply say, you're contributing to the benefit of the company in a meaningful way. You're key. So we're going to let you become a member, and we're going to issue these EPS units. So economic profit sharing. Economic profit is the amount of profit that exceeds the specific target that includes the rent on capital that an owner has in the business every year. So as an owner, you want distributions separate than how you get paid. If you actually work in the business, that's great. But you need ownership dividends, just like, say, Rockefeller, when he built Exxon and Standard Oil and all those other companies. Well, eventually he wasn't working, but he got these dividends. And today his heirs and looking through their trusts are still some of the wealthiest people in the world because the Rockefellers got dividends from oil companies that he started. He worked in them for a long time, but when he didn't, he got dividends. If you think of your business that way, keep your pay separate, your salary for doing your work separate from your distributions for ownership. And everybody needs rent or distributions from the risk of ownership. So that's what an economic profit is. So we set that up in these units, and well, then we just decided, God, we move those EVA units into that entity as well. And there's a lot of reasons for doing that legally and otherwise that help in places like California. So we simply do that. And then inside of the holding company, which is entirely owned and controlled by the managers and the founders, business owners, you just create 2 new units that flow the cash up into the EPS and the EVA units. And that's the solution. That's how this all works. Now, easier said than done. I've spent hundreds of thousands of dollars in years perfecting the agreements and testing them and making sure they would survive challenges in court, like some of the ones I faced. And you'd be surprised at how easy this is to explain to your employees and how much they get it. There's also a really simpler version, which we can get into. So somebody say, hey, Pierre, how does an EPS unit actually work? Well, similar to what I showed you with the EVA unit, the economic profit sharing unit, again, you pay it out of the money. So you say the rent on invested capital that an owner has, say $3 million of profit as the baseline. And you can say, I'm going to share a percentage of that into a pool for anything excess. So let's say year 1 after the baseline, that 1 million of economic profit, you'd share a percentage of that with EPS year 1 unit holders. Then you would do the same thing. New baseline after year 1 would be 4 million. You would create an EPS for year 2. And let's say the following year it's 5.5 million. So 1.5 million in excess of the target or the baseline, you share a percentage of that in a pool that pays out EPS year 2 unit holders. I get a question asked really frequently is, how is your system that you've created, Pierre? How is this thing better than a typical stock option or the standard type profit or capital interest that most lawyers and CPAs recommend? And I can tell you, there's a couple of big bells and whistles here. You'd be surprised at how many laws and regulatory affairs involved around stock options and what you can and can't do. And they're not very flexible once you put them in. And at times, they're not very tax efficient either. They can cause some really big problems. So ours are really flexible. And that flexibility does some things that really matter. What really, how does this really get designed that's different than a stock option? One, stock options are really regulated. This has a lot of flexibility. One of the types of flexibility I design into these programs is when people get paid. So we hold a portion of the payment in escrow. They'll vest into it, but we hold it back in escrow subject to adherence to the restrictive covenants because you want alignment with these people that are your key contributors. So you pay them out over several quarters, and as you issue other awards, it starts laddering and it creates, well, kind of like golden handcuffs, but no different than you as a business owner. You're tied to the business. For you to keep getting paid, you've got to keep investing in that business in your time. That's what you want your key employees or key contributors to do as well. So you're just laddering out the payments as how they get paid. So we say, when somebody's doing what you want, they're still there, they get 100% of the payout. That's awesome. You keep laddering it. If they were to leave, you have, as the owner inside and the manager in that structured LLC, you would have the right to buy some percentage of their units, their EPS and EVA units, back if you want to. You don't have to buy them, but say you could buy 50% of them. So we recommend that. And then people are still saying, hey, I left, but I'm still getting a 50% payout, so long as I'm not breaching the restrictive covenants. But if they were what I call a bad leaver, someone that you want to go because, well, for cause, and we all know what that means, like they didn't do it. Hard to get away with it, nowadays in certain states like California, really difficult to do this. Say, oh, somebody's let go for cause. But you have that latitude here, and you simply say, you know what, you breached some of our covenants. You weren't acting in a fiduciary manner, taking your fiduciary duty to the enterprise. You could buy all their units back for their cost, and they would get nothing. So that's an option in the agreements. You have it wherever you want. And then ultimately, if they were to breach the restrictive covenants, you could put in a contractual term, just like you would with a partner, which I have always had in my LLC agreements. Like if you did something to harm the enterprise, this thing we care about, you owe everything back that you ever got paid. Now it's very draconian and onerous, but don't harm the entity, the golden goose. Don't hurt the golden goose that's paying us all. Work with it. So that's how this thing differs from a typical stock option and all the other structures you see. There's a lot of really quite easy to implement in the structure of the templates I have, but really powerful tools that you don't get otherwise. Have you ever implemented an employee incentive or loyalty program? How did it go? What did you learn from it? What worked and what didn't? Please share your comments below so we can all learn from it.